Joe, there you are.
Yeah, I like to leave everybody hanging a little bit. Hi, everybody. Welcome to the first episode of Future Law Bootcamp. I'm Joe Borstein, CEO of LexFusion. I am personally fascinated by the future of the legal industry and really excited to launch our first episode of a show where the lawyers of today get to meet the change makers of today. There are tectonic forces brewing under the surface of the $800 billion plus global legal industry. Globalization today is allowing lawyers and other professionals from all over the globe to work seamlessly on domestic legal work. Technology is automating routine processes, but it's also climbing up the value chain. And as we know, dabbling in more and more sophisticated legal tasks as the very long years go by. The status quo of legal regulation is being questioned and changed, and we're allowing people outside of the bar associations to work alongside lawyers more and more and to try to solve legal problems at scale and also enjoy the profits of traditional legal work in certain circumstances. And finally, outside investors are pouring in. These investors see an opportunity to make what many see as a broken system dramatically better. Peter Diamandis, a well-known futurist, has the following phrase: "You want to make $1 billion, help 1 billion people." That stuck with me because law affects every single solitary person on this planet. And there are so many people to help, and there's a lot of money to be made. So whatever drives you, idealism, greed, or even just excitement in new businesses, I've been begging lawyers for years just to pay a little bit of attention to action in the legal innovation space. And I think a lot of you might find your purpose here. So today we're going to follow that money. I'm here with Mike Bryant. Mike is a partner at Knox Capital, where he invests in software and tech-enabled services companies in legal and financial services market. Prior to Knox, you should know Mike was the co-founder and CEO of NSource, a knowledge process outsourcing firm that was bootstrapped over a 5-year period. NSource was profitable within its first year, and thanks to industry-first multi-million-dollar contract to manage the North American back office of one of the top 10 law firms in the world, the company was one of the fastest growing companies in the country. Before NSource, Mike was president at Integrion, which I think many of you know, a $100 million a year leader in business process services in legal, financial services, and corporate. And he completed his executive MBA in product development at MIT Sloan School of Business. So with that, Mike, you're not a lawyer, right?
I am not, but many friends that are attorneys like you, Joe.
I'm very sorry. So the first question I think the audience would want me to ask is, you are a very serious investor in legal innovation in both the process and technology space. When did you start investing in legal and paying attention and working in the legal industry?
You know, really, most of my career has been operating businesses in the space. You know, we got a more conventional approach initially with big public companies and just gravitated to professional services segments inside of those entities, and moved from technology and systems into services. Ultimately, it brands like Eastman Kodak, when it was an iconic brand in the B2B division, and they were sort of emulating and following a fast follower around Xerox and IBM getting into services. Donnelly was an early entrant into a back office and IT offering for big law and bulge bracket investment banks. That was a tremendous run. We took that company public, sold it to another public company in New York. That's what brought me to the Big Apple. And it was in that role where I began to work with entrepreneurs in the legal market. It was the first time that we began to buy companies and integrate them into a bigger platform. And I really enjoyed working with those entrepreneurs and saw how much flexibility they had to innovate and saw the impact that they could have on problems in the market that needed to be solved. So that was the seeds that were planted at that time to really become more entrepreneurial. When we sold that company to our JV partner in Europe, Williams Lee, it was a natural leaping off point to get more entrepreneurial. And it was there that I learned, doing earlier stage businesses, I learned about private equity. and met my current partner, Alex Greger, who had an outsized appreciation for the operational talent, the management team, the advisors that you surrounded a company with after investing in them. And we took that model and really directed it at the legal market a few years ago. So long answer to that short question. Really beginning around 2017, I pivoted out of running businesses to investing full-time in businesses through Knox.
And we've talked a lot about how now this time is different. Do you feel a material difference even between 2017 and now in the market and the activities?
Yes, I mean I think the smart money that is finding its way into the legal tech space is such a positive, not just for the entrepreneurs that are being drawn into legal tech from both inside the vertical and outside the vertical. I think it's a net positive for the buyers, the consumers of the legal technology, whether you're an in-house lawyer or outside lawyer. You have more choice available to you now, and you have big companies to choose from in the space because there's a lot of consolidation going on, and you have innovative young technology companies available to assess. And I think that's an embarrassment of riches for the buyers of legal technology. I think buyer needs to beware. You need to look at these companies carefully and really understand how they're capitalized, understand that they have the staying power to support you as you make those decisions. But there's some really smart money entering the space, and we see it in many of the transactions that are announced, every day, at increasingly larger valuations. Great time to be in the business, whether it's LexFusion. Congratulations, by the way, on your latest venture. Whether you're an operator, an entrepreneur, a consumer, or an investor in this space, this is our time.
So yeah, I should note that Mike Bryant and Knox Capital were essential to the opening of LexFusion and helped us all along the way. So that is much appreciated. So you mentioned smart money moving into legal tech. How do you define smart money? Often people talk about hedge funds and PE. Who are you looking at today that's paying attention that wasn't paying attention a few years ago?
Well, I think Silicon Valley is where you need to look, and when they begin to cover the legal market in the way that they covered initially fintech or healthcare tech, that's important to see. The top flight Silicon Valley investors, make bets in contract life cycle management, to make bets in practice support tools. There's e-discovery. Some of the announcements of late with Disco's latest round of funding is impressive. Seeing the Clio valuation is impressive. You look at the investors behind Ironclad. It's the who's who of investors that are taking notice and stepping in. And I think they see that these are big problems and big inefficiencies in the market that need to be solved. It's a very large addressable market out there, and there's many players now that are entering each of those categories. There may be some losers, but typically when you see the sophisticated investors coming in, you're gonna see many winners. I think if you're a smaller competitor where, someone, has raised a considerable amount of capital, you better have a segment of the market that you're really good at. And there's plenty to go around, but you need to know who your customer is. You need to find a segment. You need to execute on it in order to survive when there's this kind of money being poured in to these categories.
That's all great points. So to the uninformed, when you see the Silicon Valley venture capital firms coming in, what does that mean to you? What kind of returns are they expecting? What does it tell you about what they see about the future?
No, I think it's like when we make investments in the private equity world, and Knox invests typically in businesses that are cash flowing already. They're through the startup phase. They're in most cases profitable, and they're looking to us to help them get to the next level. Maybe they haven't done acquisitions. They want to do acquisitions. Maybe they want to grow geographically. They want to bolster their management team. They want to add new products or services. That's where we play. And our investors are looking at typical private equity returns for these later stage cash flowing businesses are in kind of 2 to 3 times. Cash on cash returns are typical. And occasionally you'll have an outlier and it's higher. And occasionally you'll have a tough one where, you're getting your money back. The venture capitalists, those would be very pedestrian returns. When you're making early stage investments, there's risk. Higher risk betas equal higher returns, and 10 times is not unusual, or more. For these early stage investors. And, when you see some of the returns that are implied in some of the larger assets that are out there, you can see that there are comps that venture capitalists can look at and say, okay, Relativity is it's a unicorn. It's one of the most under the radar unicorns in the legal market. It's worth well over $1 billion. So when Disco is out raising capital at a $600 million or so valuation, they can point to Relativity and say, well, there's a comp. And you know what? There's room for both of them to win in this sector. So, I do think that, that's what's attracting the earlier stage professional venture investors, is seeing comps, seeing the total addressable market, and seeing that there's still inefficiencies and problems to solve in those large markets.
So let's kind of move from the professional investors to the lawyers that inhabit this ecosystem, and the law firms and corporate counsel. Let's talk a little bit about the pandemic. Was this the moment that legal innovation was been waiting for? And how do you kind of compare it to the Great Recession in 2008?
Yeah, it was a shock to the legal system, right? Because it was a shutdown, and you saw some of the adaptations that needed to take place immediately in order to keep, for instance, the access to justice wheel turning. There's not many litigators that would have envisioned deposing a key witness in a matter over video a few months ago. They would never do it. They would fly to wherever they needed to be in the room with that witness, and that just wasn't available. So adapting to remote depositions, was important, and now it's a necessity. And I think what's going to happen is post-pandemic, the good paying litigants, insurance companies, banks, pharma, they are going to require their outside counsel to continue to do remote depositions. Not for all of them. Key witnesses, experts, you can justify being in the room But we all know if you're, deposing 10 witnesses, it's usually going to be one or two that are critical. And you can argue that you need to be in the room. The others will likely continue to be remote. And I think access to the courts was another area where, again, you would never contemplate making a motion remotely. And I think you saw the trial bar adapt. You saw judges, court staff adapt to remote appearances and in some cases remote trials. I think some of the tools and technologies that exist, frankly, some of them existed a long time ago. Court call has been around for 25 years. Doing telephonic appearances, granted, but also video appearances. And now there are multiple entrants in that space. Courts, trial lawyers have to sort through all of the tools available to them and choose a tool that works for them and their particular use case, and understand that there's probably a services suite that needs to be wrapped around those tools in order to facilitate that the motion practice and the connection between the court and the litigants, whether they be represented or non-represented litigants.
So if you're a lawyer right now, let's say you're a partner at a very profitable firm, of which many of my friends are, I typically hear fear, doom, and gloom about upcoming technologies. But then I look out at the businesses that are actually out there, and they're doing things like making real estate less expensive, increasing profitability, reducing the amount of travel a lawyer has to engage in to get his or her job done, offshore support, which can dramatically reduce the costs of running a law firm and allow people to kind of break the bonds of big law while still making a lot of money, reducing the time and effort it takes to run doc review and things like diligence, automating away things like timekeeping, which provide absolutely no value to anyone. I think of this as a golden age for lawyers. I think of this as a time they get to go back to the more traditional practice of law that was about persuasion, interviewing, great writing skills and persuasion skills, and away from kind of high volume, low value tasks that I think the last couple decades have really focused on. How do you see it? Is this a good thing for the practicing lawyer in terms of their day-to-day, their lifestyle, their earnings?
I think it's a tremendous opportunity, this disruption, to create leverage and to create distance. The partners that excel
create leverage to the practicing lawyer. What do you mean by that?
Well, I think being proactive with this disruption, both internally and thinking about what resources you need, assuming you're in a larger firm, what resources do you need on your team to take advantage of this hybrid environment that ultimately we're going to live in, with some on-premises practicing and some remote practicing. And then I think getting ahead of it with your clients, rather than waiting for the inevitable outside counsel guidelines to hit you that now are basically dictating how you practice, get out ahead of it and embrace some of these tools and technologies. You'll get a larger share of the work and preserve the more complex, sophisticated, higher value work that really many of these partners covet, and go after market share right now by embracing this disruption, embracing the technology and the tools that are available that now you have some experience working with, and use it as a weapon to win, to keep your current business, but to go win new business.
Yep. So let's talk about the big news story from last week. We read that there was a $200 million SPAC, special purpose acquisition vehicle, I believe it means, opened by a couple serious heavyweights in the legal industry. Tell us a little bit about your views on that and your views on the pros and cons of that type of vehicle.
Well, I think it feeds into everything that we're talking about, Joe. I think it is underreported. I think it's really important news. The most exotic financial vehicle available right now on Wall Street are these blank check companies. And, the key to them is that they only work if you can find sizable assets that are private now, typically, and you're pulling them into this public entity. And investors are basically betting on two things. A, the management team that promotes this SPAC. And in this case, you've got two first ballot Hall of Famers that are front running this SPAC, the former chairman of Kirkland and the founder of a category, really a leader in litigation finance with Adam Kirchen. So you have two incredibly accomplished, credible managers leading the SPAC. And, the investors are so that's a big check for the investors. The second big check, which is impressive for the legal market, is that there are, frankly, enough large assets that are out there in the marketplace available to purchase and aggregate into this vehicle. They're out there. They will be targeted. And it's going to be fascinating to see where they direct their attention.
And can you quickly, for the audience, kind of describe the mechanical difference between a SPAC and a PE fund or a venture fund? Like what does it mean to engage in that sort of vehicle?
Well, it's a speculation. In the case of private equity funds, they already have raised the capital. They have a mandate from their limited partners that have committed their funds to go out and invest per their model that they've tried and true model, a lower middle market or a middle market private equity fund that focuses on business services or consumer services. They know what they're getting into. A SPAC is really built out of thin air, and it's literally a blank check company where the promoters of the SPAC go out and basically sell the dream that, here's the market, it's the legal market, here's how it behaves, here's the total addressable market, it's a big market, and there's plenty of companies out there that, when brought under one umbrella, will thrive, especially under their leadership. So I think it's a very important fact that that successful executives are attracted to the legal market, and that there's sizable enough assets out there to go after. And we could probably have another show dedicated to kind of where, if you and I were doing a SPAC with a couple $100 million blank check, where we would focus. So I'm fascinated to see, what they place their bets on. And I think it'll be a sign of things to come. I think there's going to be more consolidation, Joe, just like there will be with big law firms and mid-sized law firms. I think there's going to be some consolidation due to the pandemic. I think there's going to be additional consolidation in the legal vendor ecosystem, both on the software and the services front.
Yeah, it's great. So we only have a few more minutes. I kind of want to end with a question that kind of brings it back around to the practicing lawyers out there. Obviously, practicing lawyers, be they associates or partners, can use technology to increase their leverage. They can build technology. They can leave and start their own companies. And, alongside institutions like Knox Capital, they can invest in technology. Do you think that lawyers should be investing in legal technology in an area they understand, or they have certainly the potential to understand?
My answer to that is, why not? I mean, first of all, it's a little bit of a dirty secret that there's plenty of partners out there in the AM Law 200 that are already writing checks into companies personally.
Yep.
There's a very vibrant angel investing environment that exists on a very ad hoc basis within big law. And so I think it's encouraging to see certain law firms set up ancillary businesses where they just organize that. and do direct investing into technology companies and incubate and really help accelerate those technology companies. Their competition with big accounting, the big four, they're doing it. They set up venture arms and they invest in early stage businesses. Big law should as well. And I think it's very good for the industry for them to embrace it and involve the partnership in not just distributing all the profits every year as they have done historically, but setting aside a portion of that distribution to invest in technology. Think of it as their R&D budget, in essence, that large Fortune 500 companies would set aside. I think it's good for the industry.
And if I'm an individual lawyer and my firm just isn't feeling it, kind of what are typically the minimum amounts? If you see a technology and you believe in it, you think this is going to be the future, and at something early stage, how difficult is it to get in? Do you have to know somebody? Do you have to have $1 million sitting aside? What do you need to do?
No, I think angels, the portfolio theory there is that, it doesn't need to be a big check as long as you're willing to accept the risk. And if you want to dive into the early stage investing world, you're best served, frankly, placing 10 or 20 small check bets than you are placing 1 or 2. Mm-hmm. But I think getting your feet wet in early stage investing in something that you understand and can affect, growth with and make introductions and add value makes a lot of sense. I think it would be a great way for an attorney to start their investing career is to support an early stage legal tech company.
And I think this might be our last question, but what do you consider a small check? I mean, I think this is still an area that's opaque to most lawyers, certainly in the litigation space, but maybe even often in the deal space. Like, what does small mean? Can they afford it?
If you're raising, for instance, as an entrepreneur, $1 million seed capital round, mm-hmm. Typically in the documents, the way they're drafted, you try to put forth a minimum, and a minimum you would normally see at $25,000. Okay. So I think a $25,000, $50,000 check as a minimum is more than reasonable.
So really, the after-tax dollars of a mid-level associate's bonus. So it certainly not a tiny amount of money, but not an amount that practicing lawyers at the top of their game couldn't afford if they believe that this is the future and kind of be a part of, and maybe even hedge their bets a little. From the potential of robots taking over.
Exactly.
Awesome. Well, Mike, thank you so much. I'd love to do this again. I hope this was insightful for the audience, and we're going to keep digging into the business of law and keep giving insights. So thanks, everybody. Your host, Joe Borstein, signing off.
Take care, Joe.